This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now, once our business is registered for VAT, then we know the effect. We're going to have to charge output VAT on the sales, and we'll then be able to recover input VAT on our purchases and expenses, as long as they are attributable to taxable supplies, whether indeed those taxable supplies are standard or zero rated. It will require us to prepare VAT returns from this point onwards, which, as we'll see a little later in the notes, is normally prepared on a quarterly basis. So from the day that we register for VAT, based on whichever test that we have applied, historical or future compulsory registration, or if we voluntarily registered for VAT, from the date we register for VAT, on our sales, we have to account for VAT on taxable supplies at, if they're standard rated, 20%. But we'll also then be able to recover input VAT on the things that we bought, on our purchase costs, on our costs of services provided, our expenses incurred there. We'll be able to recover that input VAT. But of course, we may be registering for VAT at a point other than day one when you started to trade. There may have been a period prior to, i.e. pre-registration for VAT, when we've been buying and selling, and we've been buying goods, buying assets, incurring expenses, inclusive of VAT, on which we've suffered, but obviously not being VAT registered at the time, were unable to recover, to reclaim any of the input VAT. So that begs the question now that when you register for VAT, for the first VAT return that you then submit from the date that you did register for VAT, would you in fact be able to recover any input VAT on any expenses, any costs that you incurred prior to registration? This is the issue here in note 1.4, again a popular exam area dealing with pre-registration input VAT. So input VAT has been incurred prior to registration. Well, yes, the answer is, if the answer was no, it wouldn't be very interesting here, can be recovered in certain circumstances. So, in what circumstances, what costs that you've incurred VAT on, can you now, after the event, recover the input VAT? Where can we recover pre-registration input VAT? Right, the circumstances in which the trader will now be allowed to recover the input VAT incurred on goods purchases and services incurred prior to the date of VAT registration. Not VAT registration, that's not right, is it? Prior to the date of VAT registration, shall we call it. Main area. In terms of goods that you purchased, assets that you purchased, on your stock, your inventory, on your fixed assets, your non-current assets, you can indeed recover the input VAT on those costs where you had acquired for business purposes and those assets has not been sold or consumed prior to registration. So on any stock that you still have, clearly if goods that you'd bought, purchases, have already been sold off, then you cannot recover the input VAT. But if there is whatever stock you've got, if you incurred VAT on that stock, you can now reclaim. You can recover the input VAT on your inventory. You can recover the input VAT on your non-current assets that you'd purchased and that you still own. Again, assuming that they were acquired for use within the business, which again you'd assume so unless told to the contrary. Now, why is it that you should be able to recover the input VAT on your stock, your inventory? Well, one very obvious reason, I hope you would agree. If it is still in stock at the time you register for VAT, when that stock is sold, you will have to pay out, you'll have to charge rather, output VAT on those sales and then pay out that VAT to HMRC. So, if you now have to account for output VAT on the sale of those stock items, it is only right and reasonable that you should be able to recover the input VAT that you originally suffered when you bought those goods. So if you've still got the items in stock, if that was inclusive of VAT, you'd suffered the VAT cost, you can now recover the input VAT on your stock. And return in relation to non-current assets, you still own it. So at some point in the future, now you have become VAT registered, then you may sell that asset. And when you sell it as a VAT registered business, you will be required in most circumstances to charge output VAT on that sale. So if when you sell you have to charge the output VAT, it is again only right and reasonable that you should now be able to recover the input VAT that you suffered when that asset was first purchased. So in those two circumstances of goods inventory, i.e. what is in stock, and non-current assets still owned by the business there, then you can now recover the input VAT that is pre-registration input VAT on those items. One slight issue in terms of timing, it won't be a problem again in practice nor indeed in your exam, but the goods should not have been acquired more than 4 years prior to registration. Again, it's probably not going to be the case. If we're talking about services, then we have a bit more of a problem. To begin with, again, the services must have been supplied for business purposes there. But you can't look back now and say, yeah, that service that was supplied to us there, do we still have it? Well, no, it's a service that was performed. So here, it's a simple rule, it's a timing issue. And that is services, again, that you are able to recover input VAT on if the services were not supplied more than 6 months prior to registration. So if you have incurred a cost in relation to a service supplied, and that service was supplied within the 6 months prior to that registration, within the 6 months prior to registration, then you can recover the input VAT. So you may be asked to calculate, based on the first VAT return period, what is the amount of VAT that either the business is required to pay HMRC or that the business may be able to reclaim from HMRC. To be able to do that, we need to know two figures: the amount of output tax on the sales made during the period, and then the amount of input tax that we can recover. Well, we can recover it on our purchases of the period and the expenses incurred in that period. But for this, the first VAT return period, we may also recover the pre-registration input VAT, but only if it is on stock that we still own, it's on assets that we still own, or in relation to services, those services that were supplied within the 6 months prior to our registration date.
Well, having dealt with VAT registration, there may come a time, of course, where the business needs to or may choose indeed to deregister from VAT. Now, it's a bit like what we've seen with registration. We can be dealing with a compulsory situation where you must deregister or where you may choose to deregister. So here in note 1.5, let's have a look at what these rules are. Where a trader stops being liable to VAT registration when it ceases to make taxable supplies. To be VAT registered, as we saw originally, the business must be making taxable supplies. If you don't make taxable supplies, then you can't be registered for VAT. So if a trader now stops making taxable supplies, then it will stop being liable to be VAT registered. If that happens, then the trader must notify HMRC within 30 days and will then be deregistered from the date of cessation of making the taxable supplies, that is, or indeed by agreement from an agreed later date. Now there's no choice. We must notify and then there will be deregistration. That's compulsory. But what we may do is to have a situation where we continue to make taxable supplies, but they fall below a level, a deregistration limit level. In the same way as we have a limit of taxable supplies VAT registration, actually registering for VAT when our taxable supplies exceed a certain figure, a figure that changes from one financial year, one tax year to another, there from one finance act to another. What we may also see is a situation where there becomes a situation either where it's compulsory or now where it's voluntary, where we deregister. And it again is linked to a level. So a trader can also request voluntary VAT deregistration if the expected taxable supplies within the next 12 months. So at any point within the next 12 months or for the next 12 months, we view that our taxable supplies will be less than the deregistration limit, currently for us here, £83,000, then again you may choose to deregister. So that deregistration, either compulsory because you cease to make taxable supplies, or voluntary because your level of taxable supplies drops below the so-called VAT deregistration limit. We've got a couple of illustrations here that we can now review. The first dealing with the scenario that we've just been discussing. The second, a little something new coming in what we may have to deal with, and which actually becomes even more important when you move on to advanced taxation at P6. But more of that in a moment. To begin with illustration 1. So we see here that we have a company that's been VAT registered since 1990. And its sales are all standard rated, so a requirement therefore to charge output tax on the sales. But the company has recently seen a downturn in its business activities, and sales for the years ended 30th of June 18 and the year ended 30th of June 19 are forecast to be £60,000 and £49,500 respectively. Now we can see that here from the beginning of the year ended June 18 and at any point thereafter, we are looking at levels of taxable supplies on an annual basis that are well below the VAT deregistration limit. Therefore, Iris Limited can request that HMRC cancel its VAT registration. Why? Because its taxable supplies during the following 12-month period will not exceed £83,000. Now again, you don't have to do this. If you continue to make some level of taxable supplies, then you are allowed to be VAT registered. But if you wish to deregister, you may choose so to do. There are conditions here. This is provided the fall in the value of the taxable supplies is not due to a temporary or permanent cessation of taxable supplies. Remember, if you have a cessation of taxable supplies, then if you do not have taxable supplies, then you cannot be registered for VAT, and therefore compulsory deregistration rules will apply. If we do go down this voluntary choice, though, because we continue to make taxable supplies, but they are below the VAT deregistration limit, then the company's VAT registration will be cancelled from the date on which the request is made, or from an agreed later date, if you and HMRC so agree. Now then, repercussions of VAT deregistration. Remember, to the point that you deregister, you have been able to recover input VAT on your costs, your expenses incurred, and you've had a requirement to charge output VAT on any sales made. So what now happens where, at this point, the point at which you deregister, there will be no requirement for you to charge output VAT on any future sales. But you will have goods in stock, you will have assets, plant and equipment, non-current assets, all of which you have recovered input VAT upon. Now, you were allowed to recover input VAT on those costs because there was an expectation that there would be output VAT charged when those goods were sold, when those assets were sold. Well, that, of course, is no longer going to happen. Why? Because we're deregistering from VAT. There'll now be no output tax to charge. So at the point of deregistration, we have to therefore deal with this particular issue here. there will now be a deemed supply of business assets, such as plant and equipment and trading inventory, when a trader ceases to be registered for VAT, unless the VAT due on those assets would be no more than £1,000. We have a de minimis limit here. If it's no more than £1,000 of output tax that would be charged on the stock, on the goods, on the assets that we own there, then there is no requirement to make this adjustment. There is no deemed supply. But if, of course, the output VAT would be rather larger than that, then we have to account for that output VAT, and that will go into, of course, our final VAT period and our final VAT return. What may happen, however, is that the business actually disposes of its assets and its trade. So what this might be is that we are selling the business as a going concern to another entity, another business. That could be another, if we're unincorporated, to an unincorporated trader, or indeed to a company. So if a business disposes of its assets and trade as a going concern, then no output VAT will be charged, as it will be outside the scope of VAT. Now, this is where we have the transfer of a business as a going concern. The conditions here for this treatment are that the business is transferred as a going concern. And if it is so treated, if we satisfy these remaining conditions here, and the business is indeed transferred as a going concern, and the transfer of the assets and trade is deemed to be outside the scope of VAT. Now, this may happen, as we've suggested already, on a sale of the assets and trade of the business to a third party, or when an unincorporated trader incorporates their business. So what is happening is that you've reached a point in terms of your business life cycle where you started as an unincorporated trader, but you now believe that it would be in your better interests to transfer the business and to run it in the future as a company. Issues indeed that we'll talk about a little bit more, so far as the limitations of our syllabus are concerned anyway, when you read through some of the tax planning scenarios in chapter 26. But for this transfer of a business as a going concern rule to apply, and for the transfer of the assets and trade to be deemed as being outside the scope of VAT, the conditions are: no significant break in trading, same type of trade pursued by the transferee, and the transferee is or will now become VAT registered. A little example again to illustrate these basic rules. Our hero, or indeed heroine here, is Daisy, a self-employed builder, and she is registered for VAT. The business has been quite successful, and Daisy therefore incorporated her trade into a new limited company on the 30th of April 18. All of the business assets were transferred to the new company in return for ordinary share capital. Now, the specific tax implications of incorporation, read the transfer of the assets and trade, are not a part of our syllabus at Taxation UK, the F6 paper as was there. But it will be something you'll need to deal with at P6. So, where this happens, no output VAT will have to be charged on the value of the inventory and any other assets on which VAT has been claimed, since the business is transferred as a going concern. The company must be or will become VAT registered, and indeed in that respect, the company will be able to take over, if we so choose, Daisy's VAT registration number. That's down to us to decide whether to transfer Daisy's VAT registration number through to the newly formed company, or whether the company forms and registers for VAT in its own right there. Okay.
Now that we've seen when it is you have to register, or when you may choose to register, and when it is you either have to deregister or you may choose to deregister, what happens in between in terms of accounting for VAT? you'll be required to submit VAT returns, again the details of which we'll look at in a few minutes' time. You will need to submit VAT returns, and they will record, as we've already seen in the examples that we've previously had, for us to calculate for the VAT return period, normally a 3-month VAT return period, a quarter, how much output tax will have been charged on the sales, reduce that by the input VAT suffered on your purchases and expenses there on your costs, and if output tax exceeds input tax, we pay them. If input tax exceeds output tax, they, that is the HMRC, will repay to us. We'll be able to reclaim that excess amount of input VAT. But to be able to deal with a VAT return, you need to know what sales generating output tax are to be allocated to the VAT return period and what purchases need to be allocated to that VAT return period. So how do we know whether a sale or purchase belongs in one VAT return period or the previous or the next VAT return period? How do we allocate transactions to a given VAT return period? That is by reference to the tax point. Now again, this is an area that is very easily tested in the form of a Section A objective testing question. So, what is our tax point? We've said it's important to correctly identify the time of supply, or tax point as we know it, as this will determine when output VAT will be due and equally when input VAT can be recovered. The VAT rules that determine the tax point in respect of a supply of goods are as follows. First of all, we need to know the basic tax point, the date when the goods are made available, and if we're dealing with a supply of services, the date when the service was completed. So the basic tax point, the first thing that here you need to learn, is the date when either the goods are made available, dispatched therefore to the customer, or when the services supplied to a customer are completed. Now that is your basic tax point, and in any exam question, the first date that you must determine. The question then is whether the basic tax point becomes the actual tax point, and thus the date to use in determining what VAT return period to allocate that transaction to. So, if then an invoice is issued or payment is received before the basic tax point, then that earlier date becomes the actual tax point. So if we receive payment or we issue an invoice prior to when the goods were dispatched or to when the services were completed, then in relation to the amount invoiced or the cash received, that date, that earlier date, becomes the actual tax point. If, however, as usually it would be the case, that an invoice would be issued after the basic tax point, then as long as it's been issued within 14 days of the basic tax point, then the invoice date will usually replace your basic tax point. So take a moment here to consider what these rules are, and we'll test them out with a little example. So just have a little look through what is to begin with the basic tax point and what then will be the actual tax point. And as I say, we'll make up a couple of examples to illustrate. Okay, let's just summarize those rules. I've drawn here at the top of the page like a little timeline based on, to begin with, when is our basic tax point. That's the first thing that needs to be determined. That's when the goods are made available or the performance of the services is completed there. So that's when the goods are supplied or the services are completed in terms of the performance thereof. Start with your basic tax point. What then will become the actual tax point and therefore the date to use? Now the actual tax point will only be other than the basic tax point in either of two circumstances. If prior to the goods being dispatched, made available, being supplied to the customers, or prior to the completion of the performance of the service involved, that either there is an invoice issued or cash has been received. And either the issue of an invoice or the receipt of cash will represent an actual tax point. It will be based on that earlier date. That is how we will allocate, therefore, the transaction to the relevant VAT return period. If there has not been an invoice issued nor cash received prior to when the goods were made available or the services performed were completed, then after the basic tax point, we will have an actual tax point again when the invoice is issued, but only if issued within 14 days. If the invoice is issued within 14 days of the basic tax point, then it will become the actual tax point. If we had no issue of invoice or receipt of cash until a date later than that, then the basic tax point would prevail. So only in the circumstances of invoices issued prior to the basic tax point or within 14 days after the basic tax point would you then use the invoice date, or if cash has been received prior to that basic tax point, then in those circumstances you found your actual tax point. Illustration. If we supply goods to our customers on the 20th of June, then we issue our invoice on the 30th of June, again at the month end. If we do that, and we had not previously obviously issued an invoice for any part of the sale made, nor had we received cash prior to the 20th of June, then our actual tax point will be the invoice date, the 30th of June. It is within 14 days of then the basic tax point. If on the other hand we had issued an invoice or received any cash, then in relation to the amount invoiced or the cash received, if that was here prior to the basic tax point of the 20th of June, say that was the 10th of June, then that would be the actual tax point in relation to the amount invoiced or the amount of cash received, rather than using the basic tax point. But if no invoice was issued prior to the supply of goods, no cash was received, that takes that out. If then the invoice was not issued within 14 days, but was issued at this later date, then it is the basic tax point that becomes the actual tax point as well. Now, we usually see a situation in real life where the invoice date is issued within 14 days of when the goods were made available, when the goods were supplied, and therefore it becomes the actual tax point. What HMRC will also do is, again, you wouldn't apply this unless you were told clearly this information within a question, but this 14-day period can, by agreement with HMRC, be extended in line with the business's normal invoicing process. For example, the business may be relatively small and it may issue invoices at the end of each month. So we issue invoices here on the 30th of June for all sales made in June. Now, of course, that will take us back to a date prior to 14 days prior to the invoice date. So we might have been making sales from the 1st of June onwards. We might have had a sale on the 1st of June. We might have had a sale on the 8th of June, on the 10th of June, then on the 20th of June, and then maybe later as well. But all of those sales made are then invoiced on the 30th of June. If you have agreed with HMRC this particular process, then the actual tax point may still be agreed to be the invoice date. That 30th of June date could still apply. But if you are not told that in a question, then it is rigidly the 14-day rule that you must apply in answer to any exam question. So here, if you invoiced on the 20th of June and you sold the goods, you made the goods available on the 20th of June, and you issued the invoice on the 30th of June, tick, the actual tax point is the invoice date because the invoice was issued within 14 days. if we had had a sale on, say, the 10th of June here, on the 10th of June, within 14 days would have been the 24th of June, but we have only issued an invoice on the 30th, therefore the basic tax point, the 10th of June, would apply. It would become the actual tax point. So you rigidly apply the 14-day rule. But understand, again, in practice, that the HMRC may agree an extension to that basic rule to fit in with the situation here where you just issue invoices at the end of the month in which the sale has been made. But unless told that, rigidly apply the 14-day rule. So to repeat our first example here, if we have made goods available, if we've made goods available on the 20th of June, dispatched, if we had already received cash or had issued an invoice on, say, the 10th of June, then that would equal the actual tax point. If instead, if that did not happen, but we simply issued an invoice at the 30th of June, then that would equal the actual tax point. If, however, we did not issue an invoice until, say, the middle of July, the 15th, 16th of July, more than 14 days after when the goods were made available, then you would use the basic tax point, so the 20th of June would then equal your actual tax point. Now, we've got to decipher that in relation to any exam question. That's what you've got to have the ability to do. And again, in whatever exam kit you've chosen to purchase from one of the approved providers, you will find examples of that nature. Okay, let's go back therefore to our notes. So returning back, we've got those tax point details made reference to there. Please make sure, you go back through, look at the examples I've given to you, and make sure, therefore, that you've understood how to determine the basic tax point, and then from that, the actual tax point to apply. Only then will you be able to determine the particular VAT return period to which to allocate your transaction. A familiar style of question on VAT set by our F6 examining team is one where for a VAT return period, usually a 3-month, a quarterly VAT return period, where for that return period you are required to compute either the amount of VAT payable by the business to HMRC or, though less likely, the amount of VAT that is reclaimable from HMRC. Now, we've seen the basic concept here way back in our very first lecture, where we accounted for VAT at standard rate on our taxable supplies, if standard rated of course, 0 if 0 rated. So we calculated the amount of output tax due for a given VAT return period, and against which we were able to offset to reduce that amount of output tax by any recoverable input tax on the goods that we purchased, and also for expenses incurred for services performed, etc. Now, there's a somewhat more detail that we need to know as regards what amount do we charge output VAT on, and are we always able to recover input VAT, or will some of our input VAT on some costs be deemed irrecoverable, so we will not be able to set it against the output tax. So let's have a look at what these major points are. Okay. Several major important points regarding, again, the chargeability of output VAT and the recoverability of input VAT. Firstly, VAT is chargeable on the actual amount received. Now, this is going to be an issue where we issue a sales invoice, but we offer a discount for prompt payment. For example, if you pay within 10 days, then you can have a 5% prompt payment discount. Now, where we have such a discount offered for prompt payment, then if the discount is not taken, the VAT is charged on the full sales price. So the VAT is effectively chargeable on the amount that we have received. If therefore the payment does not occur by the customer, then the VAT is simply charged on the full selling price.
If, of course, the discount is taken, then the VAT is based on the discounted price. Now, in terms of any exam question, all you have to do is to work out what amount of output VAT applies to some amount of sales where discounts have been offered and where discounts have been taken. And all we'll do is to apply VAT to the actual amount received. If therefore customers have not taken advantage of any prompt payment discount offered, it will be on the full selling price. Where customers have taken advantage of the prompt payment discount offered, it will be on the discounted price. Now, in reality, of course, that sets an administrative problem. So when you issue the invoice to your customer, what do you charge as VAT? Do you charge the VAT on the full selling price or on a discounted price, and then wait to see whether or not that discount is actually taken advantage of by the customer? Now, what would usually happen, there are different ways, but what would normally happen, we issue an invoice, we'll base the VAT on the full invoiced figure prior to any prompt payment discount. If we then offer a prompt payment discount and the customer then takes advantage of it, then we can simply issue a credit note to cover the amount of the discount. There are other methods, but that would be the basic method. You're probably not going to have to deal with it, because again, you will have, this has happened, this amount of sales, the customers have not taken advantage of the prompt payment discount, so the VAT is computed on the full selling price. This amount of our sales, the customers have taken advantage of the prompt payment discount, calculate the VAT on the discounted figure, i.e. on the amounts that you received. Secondly, having made a sale, you'll have to account for the output VAT based on the tax point. Now, the tax point, as we know, is usually the invoice date. But of course, what may then happen is not simply that a customer doesn't take advantage of a prompt payment discount, they just don't pay at all. So what happens, therefore, in relation to bad debts, irrecoverable, or as we now know them, impaired debts there? Because the problem is you've had to account for output VAT when the sale was made based upon your tax point, usually the invoice date, but then no cash has come in from the customer. So what has happened is that, very bad news for you, you have made a sale, and on that sale you've had to account for the output VAT, but then no cash has come in from your customer. So not only therefore have you lost the money in relation to the sale, you've had to part with the money in relation to the output VAT on that sale. Well, quite clearly it would be reasonable to allow you to claim back that output VAT, and you will be able to do it, but unfortunately you have to wait, for the rule is that you'll only be able to recover the VAT on the impaired debt only available if the output VAT, of course, has been accounted for, so that's not a problem. You have to have paid over the VAT to now be able to recover that VAT. So only available if the output VAT has been accounted for and paid to HMRC, and the debt is, now here's what the time period you have to learn, is over 6 months old as measured not from the invoice date, but from the time the payment was due. You would be told what your normal due dates would be, i.e. within 30 days of invoicing or whatever it might be there. Now, only then, when 6 months have elapsed from the time when the payment was due to a date within this VAT return period, may you then recover that output VAT that you had originally accounted for and paid over to HMRC. How do we get it on the VAT return? The relief is claimed as input VAT on the VAT return, thus countering the output VAT on the earlier VAT return that you had recorded when the sale was actually made. Only then can you get your money back. So you've written off the debt in the accounts, you've accounted for the output VAT and paid it over to HMRC, And now, the important one, the time limitation that will be tested on you, it is now 6 months from when the normal payment would have fallen due, and that date falls within this VAT return period, such as we'll see with an example in a moment. Input VAT cannot be recovered in respect of business entertainment of UK customers. Business entertainment of UK customers disallowed. So, if we have incurred expenses upon which VAT has been charged in connection with the entertainment of UK customers, or the entertainment of any suppliers, whatever, wherever they are, then that VAT is irrecoverable. We will not be able to reclaim the input VAT. We will not be able to record it as input VAT on our VAT return. We will suffer the full cost of that business entertainment. However, if we are entertaining overseas customers, or indeed our own staff, then the input VAT is recoverable. So again, note to yourself that you can recover input VAT in relation to entertainment of overseas customers and also entertaining own staff. Those are the two types of entertainment where the input VAT on the expense incurred is deductible. It is available for relief against your output tax on your VAT return. If you're entertaining overseas customers or you are entertaining your employees, that VAT is recoverable. Otherwise, business entertaining is not recoverable. Where also you cannot recover input VAT is on the purchase of motor cars, unless, and it's very unlikely, they are used 100% for business purposes. Something like a pool car, as we discussed back in our study of capital allowances, where there is no private use allowed. It is simply available for any members or a group of members of employees there to use purely for business purposes. There is no private use. Again, usually when you buy cars through a business, it is for employees, and there will be some private use. Remember, going from home to work is private use in that context there. So it's unusual that you'd be able to recover any input VAT on cars. Also, where input VAT cannot be recovered, it's in relation to private use by a proprietor of a business. If we take goods for stock, for example, then we are not going to be able to recover the input VAT in relation to that. Can't recover VAT in relation to private use by a proprietor.
Well, before our next lecture, what I'd like you to do is to revise through the points here that we've seen in note 3.1 on our output and input VAT, and then to attempt, as you see here, example 4. Now, if you look at the requirement to it, calculate the VAT payable for the quarter ended 31st of March 18. So what it demands of you is that you're able to, in relation to your output, your sales, compute the output tax, and then establish what input tax is recoverable. But you can set off against that output tax, and the amount of VAT payable will be the amount by which the output tax exceeds that input tax. So again, go back through, revise through the notes in section 3.1 above there. Make sure you've understood those specific issues. They're the ones that tend to get tested in any such exam question. Make sure you know them, then have a go at this. And next time what we'll do is I'll quickly run you through an answer to this one before moving on to pastures new in terms of VAT. I look forward to talking to you again then.